Feel free to throw out that Windex bottle as we present to you why Apogee is a crystal clear buying opportunity.
Good evening, everybody, and thank you to the CFA Society judges for giving us the opportunity to speak today. My name is Max, and I'm joined by my teammates, Griffin, Andrew, Brandon, and Miles, and together we are proud to represent the University of Minnesota-Duluth as we initiate a buy recommendation on Apogee Enterprises with a 12-month price target of $45, representing a 14% upside. Our recommendation is backed by our valuation, which is supported by 3 primary growth drivers.
Apogee has established itself as a leader in the architectural construction industry, offering products and services in the construction of commercial buildings. The company operates through 4 distinct segments, including architectural framing systems, glass, and services, as well as its large-scale optical segment, which provides value-added picture framing solutions. Operating margins for Apogee's architectural segments are comparable, ranging from 6 to 8%, while its LSO segment is exceptionally profitable in comparison at a 25% operating margin. Apogee operates primarily in the United States, with 86% of revenues derived domestically. Overall, we believe vertical integration between its segments and Apogee's market-leading sustainable product offerings solidify its competitive advantage. Strategic acquisitions have also allowed for the expansion of Apogee's product offerings. The most notable were its Sodawall acquisition in 2016 and its EFCO acquisition in 2017, contributing to a 5-year sales CAGR of 7%, 3% of which we estimate to be organic.
Apogee is dedicated to ecological practices through its ability to capitalize on sustainable trends in construction. Apogee's energy-efficient product offerings support green building and sustainability initiatives, including its anodized metallic finishes that are made from 100% recyclable materials and generate 90% less landfill waste. Furthermore, Apogee follows strict regulations governing the use and storage of hazardous resources by employing third-party disposal companies demonstrating safe and ethical environmental practices. The company has received numerous awards for its ability to go above and beyond the current status quo of diversity and inclusion. 2018 marked the 3rd consecutive year in which Apogee was named to the honor roll for the Minnesota Census of Women in Corporate Leadership. Additionally, Apogee has given over $1 million in charitable grants and keeps employee safety at the forefront of company operations as it is evaluated annually through a safety assessment by the company's Risk Roundtable.
In regards to governance, Ty Silberhorn is the newly appointed CEO who replaced former CEO Joseph Pushis in January. With over 20 years of industry experience at 3M, we are confident his expertise will accelerate Apogee's strategic initiatives. Nishit Gupta was appointed as the CFO in June of 2020 after serving as the head of global finance operations at Land O'Lakes. Apogee's board of directors includes 3 female members and 2 ethnically diverse members, further demonstrating the company's commitment to diversity and representation.
Apogee is a leader in a relatively cyclical industry where competition is highly fragmented. COVID-19 induced a severe economic shutdown and halted construction investment throughout 2020. However, we believe the newly elected administration's proposed infrastructure bill will revive industry growth. Short term, we expect the industry to expand at a projected growth rate of 4.6%, propelled by considerable strength in the green building trends throughout the industry.
We believe Apogee's 2 closest competitors are Technoglass and Oldcastle. Technoglass holds 1% of market share, serving different end markets, primarily residential construction in the southeastern U.S. Oldcastle, a subsidiary of CRH, is similar to Apogee in size and scope with a higher concentration on glazing techniques that are used for extreme weather situations. In our analysis of Oldcastle, we found that the company lacks the vertical integration capabilities and energy-efficient products that we believe solidify Apogee's competitive advantage.
We have identified 3 primary growth drivers that support our investment thesis. We believe Apogee's success story begins with its shift towards a more favorable revenue mix, followed by the development of efficiencies through the consolidation and integration of its architectural framing subsidiaries. Most importantly, Apogee will utilize its market-leading green building products to capitalize on the long-term growth and sustainable infrastructure. Apogee is shifting its focus away from monumental structures of 20 stories or more towards low to mid-rise buildings. This transition represents a favorable long-term growth proposition that will be beneficial in allowing the company to generate a more diversified revenue stream and improve profitability. Apogee's Viracon business has already seen this change in revenue mix as revenues attributed to monumental structures has dropped from 60% to 20% since 2012. Now, over the same period, operating margins have improved 300 basis points as a result of favorable profitability characteristics, representing a 66% improvement and an 85% improvement in net margins. Additionally, larger projects have longer lead times, which can cause cost uncertainties around raw materials needed to complete these projects. Now, due to COVID-19 implications, 88% of real estate experts believe that businesses will need to invest in flexible office concepts, which include social distancing requirements and directional layouts of floors.
Apogee has implemented consolidation initiatives within its framing segment that we believe will drive significant profitability improvements by eliminating duplicate functions across its 6 AFS subsidiaries. These efficiencies will be driven through 3 cost-saving initiatives, which will generate $30 to $50 million in annual savings. We believe the company will realize procurement efficiencies, reduce controllable costs through its lean enterprise platform, and eliminate non-essential processes related to its recent acquisition, reducing cost of sales by 75 basis points throughout our investment horizon. Further, operating expenses will be favorably impacted, reducing overall SG&A by $10 to $15 million through 2023.
Green infrastructure and energy efficiency is becoming increasingly important to consumers. The number of energy efficient LEED certified buildings in the US has seen robust growth, and we expect this to accelerate in the coming years, backed by a projected CAGR of 12.4% in the global non-residential green building market. We also expect total construction spending on green initiatives to grow considerably under the inauguration of President Biden. The new administration has pledged $2 trillion in new infrastructure spending to update an estimated 4 million buildings and to provide incentives to promote green retrofits and new green builds, which we believe will further accelerate the strong growth in sustainable infrastructure. These drivers improve our outlook for Apogee's top line, where we forecast a 5% organic sales CAGR in the near term, accelerated by environmentally friendly trends throughout the industry.
Apogee capitalizes on the growth in green infrastructure through its diverse portfolio of market-leading sustainable building products. Viracon offers patented low emissive glass coatings that provide superior thermal insulation for improved energy efficiency. Apogee's other subsidiaries provide a wide array of thermal framing systems, windows, and curtain walls, further reducing energy usage and greenhouse gas emissions. Apogee also has lead green associates on staff to help customers meet their sustainable building goals, and can leverage its Apogee's renovations business to capitalize on green retrofits.
Apogee continues to maintain a solid financial position while approaching the tail end of the COVID-19 pandemic. We are forecasting improvements in net margins, stable asset turnover, and a slight decline in equity multiplier, demonstrating strength in our expectations for Apogee's return metrics. The company has already deleveraged considerably from 2020 levels and is currently maintaining a debt-to-equity ratio of 31%. Apogee also retains sufficient liquidity, backing its strategic initiatives, posting a current ratio of 1.63 and a cash ratio of 0.26. Apogee deploys its income to provide considerable dividends and share repurchases to return value to its shareholders, while steadily growing the bottom line to post consistent earnings. The company also generates healthy free cash flows, where we forecast a CAGR of 5%, generating $100 million in free cash flow by 2022.
In valuing Apogee, we utilized a proprietary discounted cash flow analysis to derive our 12-month price target of $45, where we applied a discount rate of 8.2%. We implemented a multi-stage analysis to forecast Apogee's top line using a weighted sales growth rate of 5% through 2026 and 3.5% thereafter. Due to the inherent sensitivity of a DCF and the significance of our assumptions, we stress tested our valuation through a Monte Carlo simulation, observing a 75% probability of a buy recommendation and only a 2% probability of a clear sell.
Further supporting our intrinsic valuation is our comparable company analysis, where we attached a 15 times price earnings multiple to our forecasted 2021 EPS of $2.90, leaving us with a price objective of $43. Compared to its peers within the small cap building products index, Apogee trades at a significant discount on both the price to earnings and EV to EBITDA basis.
We have identified 3 primary risks within our investment recommendation. We believe management's limited tenure with the company, along with the failure to effectively integrate previous acquisitions and sustained political gridlock, could potentially have adverse effects on Apogee's performance.
In conclusion, we would like to reiterate our buy recommendation on Apogee Enterprises. Through a more favorable revenue mix, improving operational efficiencies, and the capitalization on green infrastructure, we truly believe Apogee will reach our 12-month price target of $45, representing a 14% upside. We would like to thank everyone for joining us today, and I'll open up the floor for questions.
Hey, this is Jake Seltz. That was a really great presentation. I'll kick it off with the questions. And I guess my first one, I was going to ask a question on kind of the pandemic and changes in business model. I think you guys addressed a lot of what I wanted to see. So I'm going to just go over to some of the valuation metrics first. And maybe a two-part question. Just what did you find your price target to be most sensitive to? Which variables kind of on the DCF model? And then secondly, why do you think the company trades at a discount to its peers on a multiple basis, and why can that change going forward?
Yeah, Jake, I can answer that question for you. For your first part with the sensitivity of our inputs, Andrew, if you could go to valuation slide number 6 there. So essentially, we did a valuation sensitivity on sales and our discount rate because we believe those are the two inputs that are most sensitive within our DCF. So we found that every 50 basis point increase in our near-term sales growth rate is about a $1.80 change in our price target. And for the discount rate, a 25% move in our WACC is approximately a $1.20 in our price target. We also did a sensitivity on the terminal sales, where we noticed that every 50 basis point move in terminal sales results in a $2.50 move in our price target. So it's very sensitive to that aspect of our valuation. And Andrew, if you go back to the appendix quickly, and valuation number 11, please. So here's a summary of the companies that we chose to use for our peer group while valuing Apogee on a multiples basis. I'd like to preface this by saying that we can't construct a perfect group of competitors just because of the lack of public comps that Apogee actually does have. The closest is Technoglass. But otherwise, we opted to use companies within the S&P Small Cap Building Products Index, which Apogee is a part of. And the reason we found that Apogee trades to a discount compared to these companies is primarily because the market has not fully priced in the savings that we believe are going to emerge as Apogee comes out of the inefficiency that they've experienced from their FCO acquisition. In addition to that, most of these companies within this index actually serve the residential construction market as compared to Apogee in the commercial construction market. And these companies, especially with COVID recently in the past few months, have been trading at a premium in general. So that's why we find Apogee trading discounted to these peers.
Great. Thank you very much.
Could you maybe walk me through, I think organically, historically, the company's been growing 3%. But in your forward projections, you have them accelerated to 5%. Talk about some of the puts and takes with, COVID and people working from home and nobody wants to build a big building anymore versus these green initiatives. Like what do you think is the bigger driver to push the accelerated growth?
Yeah, I can take the portion within the work from home. So in regards to kind of what we're seeing with work from home, through our analysis and research, we came to the conclusion that there's two primary kind of end results to moving forward. And we think that first and foremost, given a successful vaccine, we think that, people will be more willing and able to go back to the offices. And then what we're really convicted on within our research is that this hub and spoke model, as you can see on this graphic in the top left. So the hub and spoke model is essentially, you have a centralized headquarters. Most often it's in the cities. So it's bringing people into kind of a congested area. But right now, what we believe and are hearing from the street experts and leaders is that CEOs want to adopt this hub and spoke model where they have smaller offices in suburban areas that allows for a flexible office concept where individuals can come in maybe 2-3 days a week, and then work from home for the remainder of that. So really we see growth in this model because these hub and spoke models, primarily the spokes, have smaller to low mid-rise office concepts, which we think will provide for a strong tailwind to Apogee moving forward.
Yeah, and then just to add on to that as well, we were able to talk to office leasing brokers And basically what they're hearing is that about 60% of employees are looking to come back to the office as soon as it opens up. Another 28% are looking to go with that more hybrid model that we just discussed. And then the remaining 12% are looking to work from home indefinitely, which isn't that big of a deal because pre-COVID, that was about 8% of the total workforce was working from home. So it's just about a 4% shift in that. So again, can you go to the appendix, please, Andrew? And then to the US square footage per employee on supplemental, number 9. Yeah, so here's a trend that we also have identified. So since 2010, there's been a 17.6 reduction in average square footage per employee. So after the pandemic clears up, we feel that more people are going to want to have more space within their work environment to have a little bit more distance. They're not as crowded together in one centralized spot, which also benefits the hub and spoke model that we identified beforehand. So this will be a synergy to Apogee's revenues moving forward.
Awesome, thank you.
I'd like to ask the question that if you were able to meet with management, what would you tell them about the proper way to deploy capital, cash flow, that is, going forward?
Yeah, I can touch on that answer. The strategic initiatives that we see Apogee currently pursuing in terms of the integration of its AFS subsidiaries, we truly believe that that is a tailwind for the company going forward in terms of profitability and the growth for that segment, which is about 50% of Apogee's total revenue. So we really see the capital that they're pushing in to developing those efficiencies and integrating those new acquisitions as a quality strategic initiative going forward, just capitalizing on the strong segment and capitalizing on their total market share within that segment.
Okay. And then I have a second question that's unrelated, and that is, how is this company positioning itself to investors who are focused on ESG?
Yeah, so can you go to the ESG initiatives, please, Andrew, on supplemental number 8? So Apogee pretty much has 4 different areas where they apply ESG initiatives, and that's to their people, products, and operations and community. So one of the main aspects of ESG that Apogee focuses on is its ESG products. So that's their low emissive glass as well as their thermal framing. And these two combined provide a lot of really good benefits to building in terms of energy savings, as well as cost savings for the building owner. So these are some of the things that management has said that they are very confident in moving forward. If we can touch on the LEED certified buildings as well, please. Where is it? In the slide deck, Andrew. Let's see. Yeah, thank you. So yeah, again, I mean, we have this really good trend within LEED certified buildings and how many are coming to market. It's becoming more and more of a prized possession to have a LEED certified building when you are making a new one. So again, having these LEED green certified products within Apogee's product segment is a tailwind for the company moving forward.
1 minute left. So as Carrie Robinson from Macquarie, I got to quit. So this is pretty convincing. So aside from you guys going out and pitching this stock, why should I buy this stock? Why would I come in and wake up and want to buy this one today?
I can take the first part of that. Well, the reason why you should buy this stock is because that with the tailwind of ESG and everything, or society kind of shifting to a more sustainable infrastructure, we truly believe that society is going to be transferring to the sustainable infrastructure, and then that Congress will pass an infrastructure bill. So with all this spending going into more LEED certified buildings and energy efficient windows, this will be a huge tailwind for Apogee, especially in their low emissive glass coatings, because As of right now, only 5% of LEED 5% of existing buildings are LEED certified. So we see this as a huge long runway for growth going into the future that can last a long time.
That's the time. That's the time. Thanks, team.
Thank you.
Thank you, guys.
All right. Thanks, Mark. Wow, another great competition this year. Thanks again to all the students that participated. As the judges mentioned, it was really obvious just the great work each team put into the research, into the presentation, the ability to adapt to this new virtual format. Of course, we have to announce a winner. And the winner of this year's competition is the University of Minnesota-Duluth. Congratulations to the University of Minnesota-Duluth and really to all the teams, but great job. Congratulations.
Thank you.
Thank you so much.
Thank you.